Welcome to The Explainer. Today, we're unpacking a real puzzle. We're looking at one of the most fascinating and, honestly, fiercely debated companies in the Indian stock market right now, ITC Limited. It's a massive conglomerate, right? A total household name. And yet, it's a company that leaves a ton of investors just scratching their heads. So we're going to dive deep into a detailed research note today to understand the complex machinery inside this misunderstood giant and figure out exactly what the market is pricing in.
Welcome to Stress-Free Investing Analysis Personal Notes. I am not a CB-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CB-registered professional before making any financial decisions.
Okay, let's dive into this. Section 1. The ITC Paradox, a monopoly that punished shareholders.
Imagine a company with an absolutely incredible, deeply moated 80% monopoly in its primary market. It's got massive pricing power, ridiculously high returns on capital, and it generates a literal mountain of free cash flow. Logically, a dominant company like that should be a massive wealth creator for its shareholders, right? Well, that brings us to the central paradox we're exploring today. How on earth could a company with such stellar business fundamentals somehow manage to underperform the broader market for an entire decade?
The contrast here is absolutely stark. Over a 10-year period, the Nifty 50 delivered a massive 110% return. In that exact same time frame, ITC stock returned just 3%. Yeah, 3%. It was essentially a flat decade. As the research note points out, this is the single most powerful bear case against ITC as an investment. The business itself has been this incredible cash-generating machine, but the stock? It just hasn't rewarded patient shareholders. To understand if this is finally going to change, we really need a structured approach. So, here's our roadmap for the day. We've introduced the paradox. Next up, we'll look at the cigarette cash cow, examine their massive FMCG pivot, analyze their overall financial health, and finally, we'll weigh the risks and deliver a verdict.
Moving right along. Section 2. The cigarette cash cow, the engine of the conglomerate. Now, what's really interesting about the numbers here is the sheer dominance of one single segment when it comes to the bottom line. While cigarettes only make up roughly 42% of ITC's overall revenue, they generate an unbelievable 80.2% of the company's profits. This is a segment with operating margins sitting well over 55%. Everything else the company does, and we're talking packaged foods like Ashirvad and Sunfeast, agriculture, paperboards, IT, all of that just shares the remaining 20% of the profit pie. Make no mistake, cigarettes are the undeniable engine here.
But, having one massive cash cow makes you highly vulnerable to regulatory changes. Just look at this recent timeline. While management successfully demerged their capital-heavy hotels business in early 2025, the real story hit in February 2026. The government implemented an unprecedented excise tax shock. They revised GST from 28% up to 40% and slapped on a new basic excise duty. Boom. This single event absolutely crushed ITC's stock price, dropping it by 27% between January and May of 2026, as the whole market panicked over how this would impact cigarette sales volumes.
And that vulnerability brings us perfectly to Section 3, the FMCG pivot, reinvesting the tobacco windfall.
Whenever you hear the term FMCG others in this research note, it's referring to ITC's rapidly scaling non-tobacco consumer goods portfolio. We are talking about dominant, everyday household Indian brands. And here is the absolute game-changer data point the research highlights. The profitability of this segment is finally inflecting. In the fourth quarter of fiscal year 2026, their pre-tax profit jumped nearly 52% year-over-year, and their profit margins are finally crossing that critical 8% threshold. They are seriously scaling up now.
Let's move to and see how this builds into a brilliant, overarching capital strategy by the management team. It's basically a three-step playbook. Step 1, protect and maximize that incredibly lucrative cigarette cash flow, even despite those tax hikes. Step 2, clean up the balance sheet. They pulled this off by demerging the capital-heavy, lower-return hotels business in early 2025, just getting it completely off the parent company's books. And step 3, take all that clean, maximized cash and aggressively scale those high-growth FMCG brands to offset any future tobacco risks.
Okay, so the strategy makes perfect sense on paper, but does the math actually hold up? Let's look at Section 4, Financial Health and Valuation, the Fortress Balance Sheet. Get a load of this number, 38.9%.
That is ITC's return on capital employed for fiscal year 2026. This is massive. It literally means that for every bit of capital deployed in the business, they're generating an almost 40% return. When you consider their cost of capital sits at around 12%, this massive spread proves that ITC is an exceptional economic value creator. They are a highly efficient, capital-light, compounding machine. And they combine that incredible efficiency with a literal fortress of a balance sheet. Even after paying out really generous dividends, the research note estimates ITC holds a massive net cash position of 21,361 crore rupees. Now, this isn't just numbers on a spreadsheet. This is a fortress buffer. If that February 2026 tax shock hurts sales for a few quarters, this massive cash reserve ensures the company can weather the storm without missing a single beat.
And this brilliantly illustrates the wild valuation anomaly the market has created. Let's compare ITC to its fast-moving consumer goods peers. ITC is generating incredible EBITDA margins of 34.6%. That vastly outperforms giants like Hindustan Unilever at 23% and Nestle India at 24%. Yet, look at the price-to-earnings multiples. HUL trades at 51 times earnings, Nestle trades at 72 times, and ITC, it trades at just 17 times earnings. It is vastly more profitable, but priced at a third of the multiple of its peers.
As the research note perfectly summarizes, the market has re-rated the stock from 24x to 17x PE, pricing in the worst case on cigarette volumes. This multiple compression down to a highly attractive decade low is entirely driven by fear over that February tax shock. The market is basically assuming the absolute worst, pushing the stock into deep value territory despite all those pristine fundamentals we just went over.
All right, let's bring it all together. Section 5, Risks and Final Verdict, Weighing the Asymmetry.
We absolutely have to look at the genuine threats here, the bear case. That unprecedented February 2026 excise duty shock is a massive headwind. The real fear is that these higher legal cigarette prices will push price-sensitive consumers right out of the legal market and into the untaxed, illicit black market, permanently suppressing volume. And as we saw earlier, when 80% of your profit is heavily concentrated in that single segment, any sustained volume decline is absolutely critical to your earnings.
So, the crucial point is contrasting those very real risks with the massive upside drivers. The bull case points out that ITC has incredibly inelastic pricing power. I mean, they've survived 5 major tax shocks since 2012 and always recovered. Combine that with their rapidly expanding FMCG margins, a very safe 5% dividend yield that basically acts as a floor, and the fact that the smart money, domestic mutual funds, have been aggressively increasing their stakes while retail investors panicked. Drumroll, please. Factoring in all of this, the Stressfree Investing Report gives a final verdict to accumulate, with a really strong score of 75 out of 100. They assign a base target of 350 rupees over an 18 to 36-month horizon. The entire thesis here is about asymmetric risk to reward. At 17 times earnings, the stock is essentially priced for failure. If ITC's cigarette volumes just stabilize and FMCG continues its growth trajectory, the re-rating upside far outweighs the downside risks.
Which leaves us with the ultimate question. After a whole decade of punishing its shareholders with flat stock returns, despite having brilliant business metrics, is ITC finally ready to shed its tobacco-only reputation? With the hotels to murder complete, FMCG profits inflecting upwards, and the stock sitting at a deeply discounted valuation, will this compounding machine finally reward patient investors? It is a fascinating setup to keep your eye on.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.